want to introduce Tom. He has multiple backgrounds, joined the group about 6 months ago. And from what I understand, besides being a lawyer and having 8 children, he has 3 title companies. He owns several pieces of real estate and has a lot of things going on in his life. So I thought he would be a great person to share and be a special guest. And he volunteered to add value for the group today. So without any further ado, Tom Fortenberry, how are you, buddy?
I'm doing fine, Ken. Thank you guys so much. I figure I'm a pretty hard act to follow from last week. So, but nonetheless, I'll give it my shot. I have enjoyed the group immensely and gotten so much value just listening to everybody's conversations and kind of gleaning things from, all the things that everybody talks about each week. I didn't really have any idea what I could share with you guys that would be of really much interest or hopefully something that could benefit you. So what I figured I would do was it's like yes, I do have 6 kids, so I get this quite a bit on Zoom calls. What I did think I would try to do and is just kind of walk you through what I've been doing in the real estate space since, a little before and as Ken and I connected up last year. And then just kind of transition that into some of the other things that I've got going on and give you some thoughts about how to structure some of your real estate deals. And try to answer any questions that you guys may come up with for some of what's going on in your own projects and your own ideas, with a total disclaimer that I'm not your lawyer and I encourage you to seek legal advice from a competent professional in your jurisdiction. So, but I can answer general questions and try to provide some value that way for you guys. And so I guess with that, I will. Ken, do I have the ability to share my screen?
You should, and if you need me to make you the host, I can do that also.
That would be way too much power. So let's see what I can do here.
Yeah.
There we go.
Oh, there you go.
Perfect. Did that work?
That did work. Yes.
Okay, great. Okay, so let's see. Hang on one second. I gotta back that up. I'm using this platform that I've never used before to do a slideshow, so
cool.
Bear with me. Okay, now we can do it.
So there's actually more than Google Slides, PPT, Keynote.
I'm telling you, there's a ton of stuff out. I'd never even heard of this program till my assistant told me about it, but he likes it, so I was like, go for it.
What's the program?
It's called Canva.
Oh, yeah.
Oh, yeah. Krista uses that a lot.
So in any event, I'll just jump right in. Kind of my philosophy in all of this stuff that I do is centered around the idea that, there are people that, try to advance their career on the shoulders of others by, I don't know, stepping on their heads almost. And so I tell this story about when I first was a baby lawyer. I worked for an old school attorney that basically taught you how to be a lawyer by beating you up every day at the office and just telling you how crappy you were, under the mindset of you were going to basically learn the craft of law by being torn down to the very shred of your existence. And then he could build you back up in the image that, he was hoping to create you in. And so every day I hated going to work for about a year. And then one day he told me, he said, okay, you're ready. You're on your own. And it was like out of the blue. And he was a great teacher. But I did not enjoy the process. So I kind of internally developed this philosophy as I'm going through life and working with other people. And I stole this from another lawyer about how to relate to other groups and projects. And that's always to do good work, give a damn about what you're doing, being willing to go the extra mile, stay a little bit later to answer questions and try to help people. And then just be respectful of people, whether you're trying to teach them, whether you're working as partners with them, whether they work for you. And so as I try to do these real estate deals, one thing I really enjoyed about this group is there's just a real camaraderie and a real respect among everybody involved, regardless of where they're at in the process. You know, whether you're a brand new person that, you know, just found out real estate was an asset class and you didn't have to buy stocks, to, you know, somebody that's a developer that's done, you know, $100 million deals. I've just enjoyed the aspect that everybody here is really seeking to do good work and they really care about what they're doing. And they're very respectful of everybody involved. And I applaud all of you guys for that and appreciate that y'all let me be a part of the group. So when I first got involved with Ken, I had one property. I'd done some real estate stuff in the past, buying and selling real rental property. But Ken challenged me to do this with no money down. And so I was like, okay, I like that. If I can figure out how to do this with no money down, then that's a good skill set. I'd like to have that because I like real estate. But I want to continue to grow this. So I had one property at the time when I first met Ken. It was this 414 Pine Street property I acquired in July last summer. After I met Ken, I acquired these other 6. And all of them are in various stages of being rehabbed and done. So I was going to walk through these deals with you and kind of show you the numbers, tell you what I did, and kind of just put out there, you know, these things really are possible. Most of you probably already know that, but for me, it was like, oh, I'd heard about that on a radio program or something, or a late night TV show, infomercial, but I had never actually done it or known anybody that was doing it until Ken challenged me and said, hey, this is doable. And I was like, okay, he said it's doable, I'm going to go do it. And so I started out with the mindset that this can be done and I will only do it this way. If I can't do it this way, I won't do it at all. And so the first property I had, I kind of repositioned it. I did not acquire it. Well, I did. It was a seller finance deal, so I acquired it with no money down. But what I did was I repositioned it by putting a renter in there with an increased rent. So I'm going to just kind of walk through the numbers and kind of show you what I did to it after I met Ken. And so I purchased it for 101. I'd put in about $3,000 remodeling it. Total basis was $104,000. When with Ken, I decided, okay, well, I'm going to get all my money back out of this property. So I went out and I got a cash out refi loan for $116,000, which immediately put $12,000 on top of what I paid for the property in my pocket. Okay. So I had no money in the deal. No net cash in the property was negative $12,000. I rent the thing out for $1,235. Property taxes, insurance, management, repairs all cost me about $400 a month. And that I've got a loan payment of about $640 on it. So it cash flows a little under $200 a month. And if you back out the loan payment, I've got a debt service coverage ratio on this one of 1.3, okay, which is low for my deals now. But this was a kind of me going and fixing a deal based on the things I'd learned with Ken. But I was able to turn it around, and it basically has an infinite rate of return and puts $200 a month in my pocket. So now I really like this house. It's nice. So
And 39,000 in equity, and
yep.
that's a perfect deal. I love it.
So that was the first one I kind of turned around. After I met Ken, I bought another house, and I purchased it for $40,000. I wanted this property because what made me want to pursue this one is it looked like a house that needed a lot of love, and it did. It was right next to a family home where my mother lives, so I wanted to be able to control who rented it. So I purchased it for $40,000, and I put $88,000 in remodel cost into it. So my total basis was about, $128,000. I did a cash out refi loan for $130,000. So my net cash, I was able to pull $2,000 out of this deal and put it in my pocket and pay myself back. I rented out for $1,600. Again, property taxes, insurance, maintenance, and management repairs is $400. Loan payment $738, and so this one cash flows at $460 a month. And now it appraises at $225. So a little under $100,000 in equity in my pocket, or on my balance sheet at least. And the cash flow on the thing is $460 a month. Again, this one didn't cost me anything, so my rate of return on cash is infinite. And actually with this one, it came with a couple little outbuildings. When I did the refinance loan, I surveyed out the property and cut off one of the little outbuildings because I'm going to turn that into a efficiency apartment. And so that I kind of look at that as just kind of free there sitting on the side. So I don't even have a basis in that one because I carved it off of this one before I did my refinance loan. So I own it outright. And feel free if anybody
that's scraping all the meat off the bone. I love it.
and feel free if anybody has questions or comments or anything, you're welcome to chime in. You don't feel like you're interrupting me.
So
Yes,
Tom,
I was curious how you can just carve something like that out. Does that require any type of zoning approval or anything like that?
It depends where you're at. So within an urban municipality, yes, you got to check and make sure that that can be done based on zoning. And if you're in a subdivision or something that's platted, you've got to make sure that that's kosher with the deed restrictions and rules and regulations governing that particular property. All of these properties that I've been doing are in rural areas. And so while this property is outside the city limits, and so I don't have to worry about any kind of platting issue or anything like that with respect to this one because of the size of the tract. And so when you're doing larger deals when you're breaking up tracts, I think it's over 10 acres in a lot of counties in Texas, you do have to, if you're going to subdivide that, you do have to do some sort of platting requirement now. But this property was a little less than 2 acres. So I didn't have to worry about that. But good question. Yes,
I
ma'am.
have a question. The purchase price, did you use your own money or you used some other lending source?
I did use, I robbed from one entity to pay Paul.
How do you do that?
And I'll explain a little bit more of that later on.
Okay.
In just a little bit, I'll talk to you a little bit about how I do this. But initially, the money comes from one of my several sources. Either I put the money in from my bank account, or I have a couple lines of credit that I pull off of from the bank. And so it just depends on where I need it or where I need to pull it from. But I do try to use as little bit of my cash as possible because I use that for the construction cost. And I've also I'm trying to build a small network of folks that are interested in getting 7 or 8% on their money, while I'm doing this for, 6 months of construction or whatever, and financing it for me. So I'm looking at that option as well. So
I was going to say that would be my next challenge. Then you just use you just keep all your money in the bank, protect your diaper money. I say.
Yeah. So that's this property. Notice on this one, the debt service coverage ratio is at 1.62. Extremely important to be mindful of that debt service coverage ratio if you're going to do these things, because banks typically want something north of 1.25 or 1.3. And so if you start doing deals with low debt service coverage ratio, that produces a gravity towards your average number and can cause banks to want to limit the number of deals you do because they won't lend anymore. And so with these deals, I'm shooting for higher debt service coverage ratios so that as I'm doing more deals, every deal makes that number better. It averages out to a higher number in the high 1.6 or 7 or 8 or higher. So that way I can do as many of these as I want, and the bank doesn't ever say, hey, we don't like the debt service coverage ratio on these. So that's something to be mindful about. The next property that I did was one in a neighboring county. I purchased this one for the payoff. This gentleman had needed to sell the property. He had it listed at one of my title companies. The seller backed out. The buyer backed out. And this guy didn't know what he was going to do because he didn't want to get foreclosed on. So I told him, I said, well, look, I'll buy it from you for what the loan is. So I ended up buying it for $78,900. I put a little under $40,000 in it. And so my total basis was a little under $120,000. I went in and did a cash out refi loan of $135,000 with a local bank. And then that put $17,000 in my bank account. And so that deal, and Ken, you will appreciate this, on this deal, on the $78,900 when I purchased it, what I did was I didn't have to come up with any money down because I contacted his private lender and I said, hey, I'm a better bet than him, so will you just roll the note to me? And so that's how I acquired this one. So
Love it.
This one rents same as the other one, $1,600. The note payment's a little bit lower, so my cash flow on it's like $490 a month. Infinite rate of return, appraised for $190, so it added about $55,000 to the balance sheet and has an infinite rate of return. So,
hey Tom, are the banks required? Do the banks want the property to be cash flow before they refi?
My banks do not. No, they don't care. Because they're looking at me and I've got all my other businesses that I've got cash flow in. So they don't mind that this entity, because when I started, this entity had probably almost zero cash flow that I do these in. But I told the bank, look, I'll be the guarantor, so you don't have to worry about that. But I want the loan in the name of the entity. And so I did that. And so what I've done with each one of these, every time I do another one of these deals, my entity looks better and better and better. The cash flow just gets better and better and better. And so my hope is that soon I'll have enough cash flow in these where they won't care necessarily so much about me. Small banks are always going to want a personal guarantee, but the entity itself would just be bankable on its own with its portfolio and its cash flow. So,
and when you refi these, are you doing it basically as soon as you've got the CO, or is there a seasoning period that the banks want?
No, I do it as soon as my contractor tells me, hey, I'm going to be done on Tuesday, and I get the appraiser out there on Wednesday, and then the bank and I close, a couple days later. So, and I've been working with some local banks. Actually, one of them is my client, so that's been nice. One of them even let me draft my own loan documents, which I thought that was kind of cool. I saved a little money. But
the town's so backed up, they let us do the second resolution. I was like, I'm like, just write it up quick.
So that was this property. The fourth one that I've finished the construction on and refied is this one. This one I did not. I do have about $2,500 in the property, but I look at it like I made up for it on the other ones. So I'm still net zero in terms of money. But I purchased it for $90,000. This deal ended up, I had helped a lady do some seller financing of this house. She had purchased it and had a loan herself. She then turned around and seller financed it to someone else. And so she was kind of stuck in the middle, receiving a note payment and then turning around and paying another note payment. And so when her buyer defaulted on the loan, she called me to do the foreclosure. And I told her, I went and looked at the house and I told her, I said, tell you what, instead of me doing a foreclosure, why don't you just let me buy the note, and I'll foreclose and take care of it all. So I ended up buying the paper, the note on this house. And then I did the foreclosure on the people that owned it. Okay. And I bought the note for no money down because I paid the amount that I paid for the note was the amount that she owed her lender on it. And so I got to keep financing in place basically while I foreclosed and had no money in the property. And then when I refinanced, I paid off her loan and paid myself back for the construction cost. So on this one, I had about $137,000 in it. Did a cash out refinance for $135,000. Similar rental from last time, $1,600. Loan payment kind of in the middle between the other two. Cash flows at $430 a month. Debt service coverage ratio 1.57. Added about $73,000 to the balance sheet. And because I do have a little money in it, my rate of return is not infinite, but it is 200%, which I don't think is bad. So now I've got 3 other properties that I'm rehabbing right now. Those I think will be ready September, and then one in October, and then one in November. And so I'll be doing the same thing with those, and those numbers should be similar to these. So that's kind of an inventory.
Tom, I got a question for you about the cash out refi.
Yeah.
Is that a percentage of like the appraisal value? Is that how it gets set, or how does that get determined?
Yes, I do it off I have the bank do it off the appraisal value.
And so the bank will determine what they're willing to be the maximum.
Well, so what happens is my bank will do 80% on the appraised value. And so, like this one appraised at 208. So my loan of 135 was below the 80%. I could have gotten more money out if I wanted to. But I have my own internal caps. Mm-hmm. So my loans, because I want, it's kind of like Jeremy had said earlier, everybody's got their kind of internal metrics about how they look at these deals. I want my loan to be such that the rental rate is about 1.2% of the loan value, because that keeps my debt coverage ratio where I want it.
Say that one more time. Tell me the divide.
I want my loan to be such that the rent is 1.2% of the loan.
Right.
The monthly rent is 1.2% of the loan.
I think I used to do that same one. There was two that people were like, what is that? I'm like, I don't know. I just, it's a number I'd like to gauge.
Yeah, yeah.
I like that. Yeah, I had.
Well, and that using that kind of number keeps my cash flow healthy, and it keeps my debt service coverage ratio where it needs to be to continue these deals.
Yeah.
So it's kind of like I could get greedy and get more money from the bank, but I want this to be a long-term thing, and I want them to be happy and very comfortable with it. And I don't want us, going into a recession, I don't want my cash flows to be tight. I want things to be funding themselves well.
So just so you know, so there was a guy, he's actually gave me a testimonial, but I have the whole thing done already. So when you're done building this little thing, I'm going to show you how to make it worth like a lot of money.
Okay.
And these guys came to me and they were all jammed up in single families like this, and they looked at it as a negative. But I literally put something together. They did something, got $695,000, and then went into multifamily and stopped calling me. So it must have worked out pretty good. But yeah, you're creating something that's going to be very attractive, and it's going to be worth millions of dollars.
So I've got 3 in inventory, and I kind of slowed down on the hunt because of my contractors were slow. But I'm working with them to increase their bandwidth, as well as I'll start looking for more properties again. So,
and real quick, can you just talk about your hunt process? Like what tools and resources are you using to find these deals?
So I'm still working on that, to be honest, Jeremy. I'm trying to figure that out. I've got a VA that is scouring the counties for different deals for me. And I've gotten a couple leads that way. But a lot of these have just come to me because I tell people what I do. For example, the lady that was doing the foreclosure, I helped her with a foreclosure on one of the properties that I'm about to rehab. She called me up to do the foreclosure, and she said, well, I just don't know what I'm going to do. I guess when I get the property back, I'm going to sell it to some guy named Jose I heard on the radio, because he buys ugly houses. And I told her, I said, well, look, ma'am, I buy ugly houses too. And so I'll be glad to take a look at it. And me, I'm a known quantity. So, I'd be a good purchaser. So I go look at the house and then make deals that way. Like I said, I keep an eye on what goes on at the title companies when deals fall through, and it looks like it might be a good candidate. I reach out to the party that's selling and say, hey, sorry your deal fell through, but would you be interested in this? So I'll use my other businesses as kind of my law firm, and the title companies as kind of a deal origination funnel. I've been watching whenever appointments of substitute trustees get filed in the county records, because I know at that point the lender's ready to start the foreclosure process, or they've already sent out the default letters, because that's what I do for my clients. But yet it hasn't gone to the auction yet. And so when my title company tells me those have been filed in the public records, I'll have my VA, skip trace the owner, and I'll get in touch with them and see if they're interested in selling before it goes into foreclosure. So those are all avenues that I've used.
One thing that I just remember, so when we had the machine going at Flippin' USA, we used to find a source when, because we'd get a list of all these properties, and every property would have a foreclosing attorney. And when we started making calls, we learned that properties that didn't disposition at the auction went back to that law firm, and the law firm had it for a little while, where if you gave that law firm a call, you could literally sometimes negotiate direct with them, before it went back, before they had to give it back or something to the bank or something. But just a thought, throw out there.
Yeah.
Speaking of the foreclosing attorneys, I'm trying to rack my brain. We had a deal fall through, a short sale that we were trying to acquire under contract, but the lender preferred to foreclose as opposed to accepting our short sale offer. you have any insight as to why certain lenders might prefer one way or the other?
Yeah, there could be a host of reasons. One that comes to mind is if the lender knows it's a good market, they'd rather foreclose and then put it back on the market and resell it because they know they're going to get the full value of their loan back, rather than short sell it to you. Because while most lenders don't want to own property, like a couple of my bank clients, they don't mind foreclosing if they have to. They'll work with the borrower and try not to, but once they foreclose, they want to book their full cost back in because that's what the Fed looks at when they come in and audit them. What did you lose money on this? If they lose too much money on too many loans, then they get rated at the Fed, and their costs of getting funds goes up. So they're very cautious about short selling, just because they want to be able to book that back in as the loan got paid off.
Is there any difference in, regardless they're taking a loss anyway, is there any difference in tax treatment from a loss on a short sale versus a foreclosure?
Well, it just depends. They may not have a loss on the foreclosure. So right now the market's been hot. So when they foreclose, get title back, they're going to put it back on the market with a realtor, and they're going to get their loan value back as long as, because a lot of the lenders, they haven't been doing 100% no doc loans. They've been doing loans based fairly conservatively and underwriting them fairly well. So when they put it back on the market for sale, they're going to get their full value back plus all their expenses and everything. And so they're not going to be out any money. I figured too, I would transition a little bit and just kind of talk to you guys about how I structure ownership of these things. Because, sorry, I hate saying the way a lot of people own their real estate is they've got an LLC, and everybody's taught, okay, you need to own everything in an LLC because that gives you asset protection. It enables you not to have some liability for your entity, because the entity owns the property. If something goes wrong, then you are not personally liable. The entity's liable. Okay. And if you needed to cut bait, you can, bankrupt the entity and move on down the road and start a new deal. That's a good strategy. It's not the best strategy, but it's a good strategy. The reason I say it's not a better strategy is because having an LLC protects you from liability generated from owning things in that LLC. So, your LLC is the landlord. Something happens with a tenant, they can sue the LLC, but not you, because the LLC is the owner. The thing that a lot of people miss comes into play from their own personal liability. You're driving to Walmart and you get in a car wreck and you hit somebody that's crossing the street because you were texting on your phone. Well, you're liable, and your LLC is not a protected asset. Even in the great state of Texas, where we are a debtor state and we can have an unlimited homestead exemption that is creditor protected, LLCs are not. And so your creditor can go after your LLC ownership and basically become, depending on how your LLC is structured, can get access to the LLC's ownership. Once that occurs, well, then they have access to all the assets that are owned by that LLC. So a better strategy is to protect your assets from not just liability that the assets themselves generate inside the LLC, but to protect the actual LLC itself and the ownership, is to put a firewall between you and your LLC, which is an asset protection trust. The good thing about that is if you generate personal liability, then the asset protection trust owns those assets for your benefit, not you personally. Yes, Ken.
I had a question. So I have that set up where my personal assets are in an irrevocable trust. Is that the same type of thing?
It can be, yes. And when I use the term asset protection trust, they take various forms. It could be an irrevocable trust. It could be a trust, statutory trust in some of the states, like I think, what is it? Nevada has a trust. Alaska has one of those asset protection trusts. And so, depending on how it's set up, yes, that can be the irrevocable trust, can be the asset protection trust. There's a lot of things to jump into.
Yeah.
Well, go ahead.
I mean, I'm just share it for everybody. But when I, went into business and I did that $17 million project, one of the things that I had to do was, I think you mentioned it, put my name on the line relative to a performance bond. And, back then I didn't have a lot, right? So I remember meeting this attorney, tax savage. He's like, "Oh, dude, you got to put it in an irrevocable trust. They'll never take your home away from you." So, I mean, I don't, that's what I always did. But anyway, I share that. If you have personal assets that you never want to lose, I think what Tom's saying today is very important that you look into.
Yeah, put a firewall between you and your assets, because that way you still can have access to all of those assets. But if you get sued or something happens terrible in your own life, divorce, car accident or whatever, then those assets it makes it more difficult to be touched. Now, I say more difficult. Lawyers can sue for anything and try to go after anything, but think of your LLC, think of your asset protection trust as firewalls that kind of put the brakes on someone being able to access and get through those things. It's possible. If you treat your LLC like your personal bank account, then a court will look right through that and call it your alter ego, and your LLC won't provide you with any asset protection. But if you run it properly and you treat it like a separate entity, same thing with your trust, it serves as a very effective firewall that prevents lawyers from getting through to the other side of that entity. So,
are you holding each one of those properties in one LLC, or do you have LLCs for each of the properties?
So I've looked at, I've done it both ways. I used to have, in this particular case, I have just one LLC that I've got all these in. I'll put, I don't know, several, when I get up to about $1 million worth of real estate, I'll do another LLC and separate them out that way. Some people use a series LLC to own property. I'm not as fond of those because they're relatively new in the legal space. And by that, I mean, they're only like 20 years old. And so there's still not a lot of case law out there on those to show that they really will withstand the test of time. So I just use a simple LLC and have it structured where it's owned by a trust, and my family is the beneficiary of that trust. And so that's
so
kind of how
the LLC is owned by the trust, which
Yes.
gives you the extra protection. So you can basically put a bunch of properties in one LLC. I like that. Okay.
Now,
So-
if you were to do multiple LLCs, does a single asset protection trust still maintain that level of an appropriate level of coverage?
Yeah. No, your single asset, your single trust, one trust can own a ton of LLCs. So you would just basically expand the diagram, have another LLC with 3 houses off of it that would be owned by your asset protection trust. And so that's kind of that's the way I suggest people try to structure things. Have at least one asset protection trust that your assets are owned in. And then that way you don't really own anything. you can control a lot, but own very little. So
Yeah.
if you were in Texas, I would tell you that, the only thing you should ever have in your personal name is your home, because nobody can take your home in Texas but the state for not paying your property taxes and the mortgage company that has the mortgage on it. Nobody else can take your home in Texas.
Yeah.
And so you can have a car in Texas and some horses. All of those are homestead protected. And so, but everything else I would own in a trust, because that gives you a much better negotiating power if you're ever in a situation where you get sued, because then you don't have assets that are easy to get to.
Now, one of the things that my partners and I have opted for is to do a single LLC for each individual property, but it's because we're using hard money for each one. And in pretty much any hard money lender that we're coming across, there is a clause that if anything happens, they take the LLC. So we don't want to risk commingling other assets and risking, them taking other things that they have no.
Oh yeah, no, and if I were in your shoes, I would probably do the same thing.
Yeah.
Okay.
And I think what really complicates things, is if Tom was bringing in investors to put the seed money in, or he had an investor in one deal that wasn't in another deal with another guy or something, then he may be forced to separate entities too. But the way he's kind of, he's like a little submarine. He took a deep dive, come back up with 6 properties. Now he's cruising on top of the water there. But no, I mean, I think, you took it into your own hands. Now the trick is, does it make sense to use hard money to bring in the private guy, pay him 6 or 7% or a little bit extra? Because now that you have this track record, you'll literally have money thrown at you. You just, because you have something to show for it. It's great.
Well, and I don't have no problem having more LLCs. I've got, I don't know, maybe 20
It
of
all,
them.
it all goes back to one holding company. So your balance sheet essentially goes to the trust.
Yes and no. I've actually got multiple trusts.
Okay.
One of the advantages of being a lawyer is I don't have to pay one to do my documents. So I don't mind. I form LLCs like, people buy toilet paper.
Yeah.
So the next, so I noticed I said this was, the first way of structuring things here is good. There's a better way here with the asset protection trust, but then there's a way that I find is the best way in my mind. Now, this is obviously, well, I'll just change slides and then talk about it. Okay, so notice we've got a similar setup here on the right. We've got an asset protection trust that owns your property LLC, okay? And that property LLC then owns the houses, and of course it could be more than one property LLC. Now, sometimes I've mentioned to you that I'll temporarily use some of my money to buy something and then lend it over to my property LLC to buy these, either front the construction costs on the houses. Well, where that money comes from, if I don't pull it off lines of credit, or I've got some credit cards that are like 0% and they don't charge me anything. So I've used those before. But if I actually have to dip into my own cash, it comes from a lending LLC that is owned in a separate asset protection trust. Okay, because my lending LLC and my separate asset protection trust I insulate from any liability whatsoever. So I try to keep most all of my liquid assets, stocks, life insurance, bank accounts, those kinds of things, owned in a lending LLC that's in my separate asset protection trust. Because those entities generate no liability. They don't have renters. Nobody is coming onto the property that could, fall in a hole and sue me. And so I keep those things very safe. And what I do is when I need money for construction costs, I'll do a loan from the lending LLC over to the property LLC, and I'll put a lien on the property. And then I make payments back to the lending LLC when it's all done. So that way I've separated out my liquid assets from the actual property assets. So my hard property assets are in one kind of silo of trust, and then I have my liquid assets in a separate asset protection trust. That gives me the ability, if something goes wrong with those properties, then my lending LLC has a prior claim on those properties before anybody else because they have a lien on them. And it can be sold, foreclosed on by the lending LLC, sold, and the lending LLC can be paid back.
I love it. Yeah, it's funny. I never drew it out, but I have a company called Advanced Capital Funding that I used to do the same thing. I would fund the smaller stuff. It's brilliant. I just didn't have that extra asset protection trust. I love that. And what kind of trust is that what it's actually called, an asset protection trust, or I only knew revocable and irrevocable.
So the term asset protection trust is just a marketing name. Okay. Revocable and irrevocable are actually classifications of trusts in the law. So a revocable trust is a trust that you can change the terms of, cancel it anytime during your lifetime. Right. An irrevocable trust is a trust that cannot be changed once it's been set up. Yeah. And irrevocable trusts, if structured properly, provide asset protection from your personal liability, whereas revocable trusts don't, because a revocable trust can just be changed, and so there is no protection. So,
got it.
So I just use that to say that that's an asset protection trust, and it would be structured as an irrevocable trust.
Right. Got it.
So
perfect.
Oh, I didn't know Jeremy had a question, but he must be talking to somebody else. So that's kind of how I have that set up. One thing I like too is that asset protection trusts for the liquid assets. You could think about having a foreign trust that is that trust, because there's some advantages to that, because then it makes it even more difficult to get to, as well as if it's structured properly, when you die, those assets, if they're structured in a foreign trust overseas, can be disconnected from the U.S. tax system. So there's some advantages to, looking at that, holding your liquid assets in some sort of foreign setup. So now, another thing I just throw out, a lot of you guys do some professional services. You guys provide professional services in some capacity, whether it's consulting or whatnot. And I check with your accountant on this, but this has worked really well for me. And I'll share this with you guys too. This is where your consulting business is owned through your asset protection trust. And when your consulting business does work, as long as you don't have any employees, you're the only person, you're just doing distributions from your LLC down to you personally. Well, in a normal LLC situation where you're doing consulting, you end up paying a self-employment tax, because income that you have coming to you from an LLC is still subject to the 15% self-employment tax. With the consulting business that you have owned in your asset protection trust, it transforms that income to become Schedule E income on your tax return. And you do not pay self-employment tax on your Schedule E income because they're trust distributions. And so you save 15% in taxes if you structure your consulting business this way. And of course, your consulting business can be a manager of most all of your other enterprises, and can be the source of how you can kind of aggregate income from your various businesses into one LLC structure that then can save you from, lower your tax bill somewhat. So This has nothing to do with real estate, but I knew it might be
Actually,
relevant to the group.
This is really important. Justin, are you there today? We talked about this last night because I asked the young gents there how they pay themselves, and they said partner distributions. And I said to them, you have to, when I first started, I had the C Corp paid an S Corp, the S Corp paid 2 LLCs, and then the LLCs literally paid our kids in a couple instances because we could, there's a certain amount you could pay your children and get a tax-free write-off.
Yep.
But this is basically what Tom is showing here. This is how everybody that's thinking entrepreneurial, this is what the government allows you to do to take it, to take advantage of the few advantages. So you have to do it, right? Makes sense. There's no reason not to do it.
But Tom, I thought that the tax treatment of a trust is essentially, you're paying almost double the, federal income tax rate. Is it not the case because it's LLCs funneling to the trust?
No. So what you're thinking of is there are 3 ways that a trust gets taxed. One of 3 ways that the IRS will tax a trust. They'll tax the trust itself. And so the trust itself, its income is taxed. It has its own tax return that gets filed. And therefore, in doing that, that's where you see the higher tax brackets. You get up to the highest tax bracket immediately at like $12,000 or $16,000. Okay. With the other way to have a trust taxed is if it's taxed to whoever created the trust. And the third way is to have the trust taxed to the beneficiaries of the trust. When it's taxed to the person that created the trust or to the beneficiaries of the trust income in the trust doesn't pay the tax rate of the trust. It pays the tax rate of the individuals that created the trust or the tax rate of the beneficiaries. And so my trusts are all taxed either to the grantor that created the trust or the beneficiaries so that I don't pay the trust tax rates.
I just want to thank you for the wealth of knowledge that you're bringing. I've had these questions in my mind for as long as I got into the real estate investing business over the last year. And I wish I knew just to ask these questions to you then. Thank you. Thank you for all the value.
I'm glad to help. I know I'm running short of time, so I'm going to wrap it up. The last slide kind of shows what I guess, Ken, you had alluded to me kind of working on a strategic plan of creating some synergies between all of my different things that I'm doing. And so I just wanted to share with you guys what I do, the things that I've got going on, and then just encourage you guys to think about the different things that you do as well and how you can create some synergies between them. So I've got 2 law firms. One is the Silverleaf Legal Group that does estate planning and asset protection. I've got my real estate law firm that's the Thomas D. Fortenberry Attorney at Law. I've got my title companies that are branded under Patron Title. And of course, the real estate law and the title companies feed each other. I get clients from the title companies, and the title companies get business from my real estate deals, though from clients that I have where I can control where we close. My real estate investing company is Cypress Lake Enterprises, and of course, I get deals from the title company and the law firm from those. And the estate planning asset protection firm gets clients, shares clients between the law firm. And as I get this off the ground, I've just started this Laurel Leaf Capital, and that's going to be my capital raising company that I will kind of feed into the estate planning, because people that do estate planning have money that they need to invest. And so, I will be leveraging those relationships there to raise money for Laurel Leaf Capital, as well as the sovereign asset advisors I don't have on here. It's my financial advisory company. And then at some point, I'm just now starting to get into buying small businesses. because I want to have some diversification on where my income sources come from. And I just love small businesses. So I'm looking at buying small businesses in the space of construction and kind of web type businesses, looking at buying. I'd like to buy some recession proof type businesses. So those are things that I'm looking at, and kind of all of that feeds each other in some sense. So that's kind of my strategic plan. And along the way, I'm looking for good partners, and by doing things like this, helping other people achieve their goals. So if I've got something I can offer my experience or my time to, I've enjoyed the opportunity to get to help other people. And so I like to teach. It's fun for me. And so I like to tell people a little bit about what I know, and hopefully it's beneficial to them and not too boring. Lawyers can sometimes be fairly dry at times. So, but anyhow, that's it for my presentation. I appreciate you guys and your time and your value that y'all have all brought to me. So I hope you got something out of it.
It was awesome, Tom.
That was absolutely spectacular. I thought I knew all that stuff, but I learned a lot today. So thank you. That was great. I'm going to be making some adjustments because, yeah, I had most of that, and I have a big org chart that I just need to, take a close look at it and just make sure everything's battened down tight. That's perfect. Very well thought out. I love your strategic plan. Very, very impressed. You're a humble man. That's a tough act to follow. Great. I mean, outstanding job. Seriously, Tom. Thank you so much.
Well, I appreciate you guys. Appreciate all y'all. So thank y'all.
Yeah.
Yeah, that was great. Thank you.
Yeah. So we got some time for a few questions. I mean, that was profound. And, he let us interrupt a few times during, but if there's any other questions, now would be the time. And I'm going to go walk with a money guy at 3:15 around the park.
Hey, great presentation, Tom. Thank you so much.
Yeah.
Oh, I appreciate it. Thank you guys.
Sounds great. So we shall
Thank you,
see everybody soon. We'll see everybody soon, and make it a great day. Tom, thank you so much.
All right. Thank you guys.
Take care. Bye.
Bye.